Well, Turkey's government is teaming up with 3 domestic banks to provide loans to businesses that it says will help boost exports and create new jobs. Ziraat, Vakif and Halkbank will lend nearly $5 billion to businesses in the agricultural, food processing and manufacturing sectors. Interest payments on these loans are linked to Turkey's inflation rate, but borrowers can defer payments for up to 2 years. The Finance Minister Berat Albayrak says this loan program and other reforms aimed at boosting domestic industry are reducing the country's dependence on imports. He predicts the current account will be in surplus by June.
Exports are going up and imports are falling. For the first time in AK Parti's 18-year rule, we will have reached a current account surplus as of June.
Well, for more on this, TRT World's senior business producer Mobin Nasir joins us now in the studio. Hi Mobin. Tell us a bit more about why the Turkish government is doing this. We know that, as the minister says, the economic figures are looking a bit more positive. So why are these reforms important?
Of course, you know that the leader has been under pressure for the past few months, and there are a number of factors behind that. Of course, private sector debt has been a key challenge for the country. That issue has been compounded, of course, because of the rocky relations with the United States, and we've seen the government ministers, various ministers, saying repeatedly that the currency is under attack from foreign elements. At the heart of it is the private sector debt. As you know, the government itself owes a relatively low amount, just about 35% of GDP. But the private sector has been borrowing heavily while US rates were low. That's, of course, changing and has been putting pressure on the Turkish lira, similar to what's been happening in many other emerging economies. We've seen the yuan, the rand, the Pakistani rupee, all taking a beating against the dollar. So really, the government seems to be trying to work towards reducing its reliance on foreign loans.
As we know, this is the latest in a series of initiatives announced by the Finance Minister and the government as a whole. What does this particular one hope to achieve?
I think the lesson learned here is that there should be lower dependence on loans, particularly for developing businesses that have a longer gestation period. In this case, the government is focusing on a few key areas. They've identified chemicals, synthetic fibers, auto parts, computers, electronics, and then moving over to the agriculture sector. They're seeing an opportunity developing in the soybean market, in greenhouses, to really be able to ramp up production, but also do that without depending on foreign loans also, and also on foreign raw material. So really, this is part of that new economy package that we've been covering for the past few months now. And the hope is that as these industries ramp up using this financing, they'll not only be able to substitute some of the imports that the country currently buys from other countries, but also create more jobs and earn more foreign proceeds through exports.
As we also know, Turkey's lira has been under a bit of pressure lately. Will this initiative have any sort of a flow-on effect on the currency?
Well, I think there's a number of factors that could perhaps provide support to the lira in the upcoming months. We know that relations with the US are on the mend, or at least they appear to be. We know that the two presidents will be meeting. President Erdogan and President Trump are expected to meet soon. We also know that foreign proceeds from tourism should get a leg up in the next few months. It's peak season here in Turkey. And of course, some of those pledges that we've been seeing over the past few months, like the $15 billion pledge from Qatar, that has not materialized yet. So as those inflows gather, it should prop up the currency and really help stabilize it against foreign currencies.
Okay, Mobin Nasir, always a pleasure. Thank you.